Welcome to the Stock Play of the Day Overtime Edition. We're going to discuss the trade that we did in Hartford Financial this Monday. We'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. Now, this week on the Stock Play of the Day, this Monday on June 1st, we looked at Hartford Financial. Myself and my colleague, Lindsay Bell, talked a little bit about the financials in general, and we talked specifically about Hartford Financial. That symbol is HIG. Now, when we were looking at that trade, we were saying, well, the markets were in a little bit of a different time. As we're taping stock play of the day overtime, we see that we now currently have the Dow Jones Industrial Average up over 1,000 points at this moment, and we had a pretty much a big rally in everything. But the financials were, in general, the whole industry really brought the whole market up, and we also saw a new high in the Nasdaq, which we were actually talking about on the stock play of the day last week, and we'll look at that in just a little bit. But let's get to our trade. So last week on Monday, what we have here is a 5-day, 15-minute interval chart, and if we look at that, Monday at noon, this is when we were talking about HIG. Stock was right at 39. It was going right around, I think it was 39.03, actually, to be more exact, when we were looking at putting on our trade. And we just talked about, in general, that the financials might be something that would be of interest to do our strategies on. And by looking at the financials in general, the one that we picked out to talk about as our paper trade for the week, not meant to be a recommendation, is HIG. And we looked at selling a put spread. Now, a lot of times you might think of this as selling a cash secured put in this underlying, but with this marketplace, with the VIX at the time was around 29, and we still have a high volatility in all the stocks just in general relative to 6 or 7 months ago. So we always want to buy some protection. So the trade that we actually looked at is called a short put spread, or otherwise known as a bull put spread. What this does is it says, well, if the market comes down to my short strike, well, then I have some risk. But if the market stays where it's at, or continues or goes on up, well, then I can make the net credit received to the account. But what we were really talking about was, well, if we can get a little bit of a push down in the underlying stock, we wouldn't mind buying 100 shares of this stock at that strike price. So the official short put spread that we looked at, I have it already up here on my screen. This is where Hartford Financial is at right now. It's up big again today. It's at 47.27, up $2.99. We have the Ally Invest option chains here. On the right-hand side, we have the puts. On the left-hand side, we have the calls. The expiration that we looked at was the July 2nd expiration. It had 34 days remaining. Now we have 27 days. We do have a little bit of wide markets, and we kind of address that. That's part of the reason why we did a spread also, is that this isn't a very liquid option, or I should say, the options on the underlying aren't very liquid. We had fairly wide bid-ask spreads, and you're seeing that right now. These options at this point in time are pretty far out of the money, and we still see that this is trading for a net credit of 17 cents. But we have like a bid on the option that we're selling at 0 by 96, and on the one that we are buying by 0 by 62. So I would try to work this trade right now at this point in time, and what would I be looking to do is just get out of the trade. The market has ran up almost 20% since we put on the trade. If we go all the way back to the chart here, we went from 39, had a big gap opening just today, and we see we're all the way up to 47 on the underlying stock. And it went actually up toward almost reached 50. Before it came down just a little bit recently. So overall, we've seen the stock do a very good rally. The only bad thing about this trade, if you could say it's a bad trade, because overall the stock is going in the direction that we would like it to for a short put spread. The only bad thing is that the stock didn't come down and give us that opportunity to buy. So at this point in time, if I had this trade on, I don't like the bid-ask spreads. That's kind of an issue here. So we would be buying to close the 35 strike put and selling to close the 32 strike put. So that would be the trade. This was the initial trade that we put on, and I would try to work that and get that closed for, I put it in maybe for a net debit of a dime to my account. Might even start at a nickel. You might have an opportunity to close it at that point in time. But I definitely don't want to hang around. We still have 27 days remaining to that expiration date. So there's to try to save a dime or even a nickel on the trade off of the 45 cents that we received when we first put on the trade. It just isn't worth that time frame. So what could we do? We obviously the stock made a bigger run up than anticipated. We were kind of hoping that maybe it would come down, and that put would allow us to buy that underlying stock. We talked about if that stock came down to 35 and you had $3,500, which is 35 times 100, the number of shares that contract represents, that would be the ultimate goal, is to buy this underlying stock at that lower price. Stock never came down, it ran up. We did it for a net credit of about 45 cents to the account. So we're trying to capture as much of that 45 cents as we could right now. And if you still wanted to get long, what the concept would be right now is that you would close out this, capture as much of that premium that you got, that you received when you first sold that, and then maybe buy the underlying stock where it's at right now if you're still bullish on that underlying stock. Market has made a pretty big run up. As I look right now, I see the S&P 500 index is up over 91 points at this point in time. So we're seeing about 3% moves across the board in the indexes. And I just wanted to highlight one other index that we did mention. We kind of talked about the fact that the NASDAQ, the NDX we're showing here, was above all of its moving averages, and it had kind of taught right in here. We saw that the NDX came on up and kind of had a ceiling right in this area, but it had touched that ceiling about 3 or 4 times, and sometimes when it breaks out, you have that momentum to carry you to the next high. And we see that we've already reached an all-time high in the NDX. So we're all the way back to pre-coronavirus days in the NASDAQ and the NASDAQ 100 index, the NDX. All right, so that's going to be it for the stock play of the day. Please make sure you ring the bell and you click subscribe, because we tape the actual stock play of the day every Monday at noon Eastern time. See you next week.